Right, and we are ready to go.
So,
Yep.
Todd, why don't you go ahead and just kick us off since
Yeah.
we do have to elect a chair.
No, we don't have a chair. So I'll just kind of start off, call to order, go through the agenda. First item is appointment of a chair. I had said in the past, I'm glad to do this. If somebody else is interested, that's fine too. Don't know how officially we need to go through a nominating process or not, but
Why don't we have someone make a motion to nominate someone for the chair?
Yeah.
And since
I
Todd is the only-
nominate Todd Burke for chair of this august body.
Is there someone else? Art Wallace is not a member, so we would need someone else to do the nomination. Heather, are you willing to second that? Okay, we got a second
I'll
from
second.
Heather.
all right.
Is there any further discussion? Right, all in favor? I'm going to do this, Todd, so you don't have to nominate yourself. Please say aye.
Aye.
Okay.
All right, so there's the nomination, close the nominations. Any other discussion? If not, all in favor of Todd as the chair of this committee? All in favor?
Aye.
Aye.
Okay. Any opposed? Okay. The ayes have it. Okay, so now that's me. Thanks for that overwhelming support. Now we'll do the same for vice chair. I'm not even sure who's on this committee, to be honest with you. I know now I am. I think it's myself and Bert from finance. Heather, are you the rep from?
I am, yes, and Steve Antonio.
Okay. And then the Board of Ed's supposed to have 2 as well.
I know there is still one open vacancy for the Board of Ed.
Okay. Do you know who the assigned person is? Is it Brian still?
Yes, it's still Brian.
Okay.
And then we also have 2 members at large. Or community members.
Are those both vacant?
Yes, they are.
Oh, okay. I'll open for nominations for vice chair. I think it's really up to
Heather and Bert, who wants
Yeah.
to do it?
Well, we wouldn't want to have 2 members of the same board, would we?
no.
So Heather, are you
I
willing?
nominate Heather Getz for vice chair.
Why, thank you.
And I will second that.
Nice.
All in favor of the nomination, say aye.
Aye.
I'm going to assume that the nominations will be closed. All in favor of Heather as the vice chair, say aye. Aye.
Aye.
Any opposed? Okay, congratulations, Heather. All right, so now we've got the chair, we've got the vice chair, and we'll move on to the regular meeting schedule. The next item, looks like in the materials, there's, after this one, there's 2 meetings that are scheduled for September 3rd and December 3rd. Don't know if we need to vote on that or just generally say that that works. We need to vote
Kelsey.
on it?
If we could vote on it, that would be great.
Okay. Does it, everybody okay with these dates? In favor, say aye.
Aye.
Okay. That's, I say aye as well. So that is unanimously approved. So Kelsey, it's the 3rd of September and the 3rd of December.
Great, thank you.
Okay, those are the housekeeping items, and we'll move on to the review of minutes, which were in the packet. I don't know if anyone had comments. The only thing that I'll say is that in the 2 meetings I was represented as a member of the Board of Finance, and I was not on the Board of Finance at the time for either. In September, I was on Board of Ed, and in December, I think I was still on Board of Ed, technically. So does anyone else have any changes?
Having not been on the board prior, am I to abstain on these minutes? Obviously, I didn't watch those meetings or participate in them, so I'm just uncertain if I'm abstaining here, or does that matter?
I think that's fine.
Not having been in attendance, I'm going to abstain as well. I don't know if we have enough people to approve the minutes.
So I think in the past it was permitted if you weren't at a meeting to go ahead and approve the minutes. And we need to get those approved. If for some reason that's wrong, we can,
Well, they look good to me. I move that we approve the minutes.
Okay, I'll second that.
Okay, with the adjustment that I said, all in favor?
Aye.
Aye.
Okay, that's 3 for 3. So we're set on that. That will be for both of them. There were 2 sets, so we'll take that approval for both sets of minutes. So we don't have to do that again. And then we'll move on to Chris and Tyler's updates. Thank you.
Great. Thanks, Mr. Chairman. Good morning, everyone. I have to say, this is exciting. I've known Todd and worked with him when I had a full head of hair, actually. So it's been quite some time we've known each other. So very exciting.
Likewise.
Well, again, good morning, folks. Tyler's brought up the deck here. We're going to hit the highlights as we typically do. The one precursor before we begin to dig in a little bit, we'll obviously do our customary updates on markets and performance of the pension plans, of course, and the OPEB trust, as the agenda mentioned. And just as a forewarning or a guidepost for us collectively, we did have occasion, Tyler and I, actually, Tyler, it might have been Paige and I, to meet with the Board of Finance back in, I think, the February meeting, Lisa, if I'm remembering correctly, and we had
I
talked.
can't remember, but recently, yes.
Yeah, I think it was the February meeting, and we had occasion then to talk a little bit about our expectations for markets and some potential changes to the portfolios, which the Board of Finance was fine with, and as a technical matter approved, but of course said subject to the input and the approval from the subcommittee. So we're going a little bit backwards, but the thought was from an efficiency standpoint, with your approval this morning on some of these changes, we'll move forward with the execution, and we'll describe those to you, obviously, and get you caught up on the rationale. So with that, Tyler, I guess we probably, both of us would be reprimanded on the next page, right, if we didn't invite folks on the call to our conference in September. If anyone has occasion or interest, obviously a lot of direct flights from Bradley to Chicago, and would love to have folks out there. It's proven to be over the years a well-attended event, and we've got a pretty robust agenda around retirement plan, fiduciary responsibilities, and market updates and whatnot. So stay tuned to that, and would love to have anyone if you're inclined to come out. So that's our housekeeping. Maybe we can jump, Tyler, right to page 13. I'm gonna, let me see here in the deck, scroll back. Maybe my page counts are different. I was working off of Kelsey's deck. Go back to the themes page, if you would. There you go. Perfect. Thank you. So just quickly for the committee, right? Roll back the clock for 10 seconds here. You'll remember we ended calendar year 2023 with a good deal of momentum in capital markets. Both equity and fixed incomes closed the year very strongly. And a lot of that enthusiasm, you may remember, centered on this premise that the Fed was poised to begin to offer the markets interest rate cuts, sometime around the middle of this year. The thought was inflation was under control, the economic recovery was largely mature and maybe on the cusp of beginning to moderate, and markets got very enthusiastic over the notion that, hey, we're going to get a lot of rate relief sometime in the middle of this year. Lo and behold, as you all know, that has not happened. The economy's proven to be a bit more resilient than first anticipated. Inflation is down for sure, not quite to the levels that the Fed wants it. And the evolving narrative, if you will, in the calendar year that we're in currently has been much more reserved about the notion and premise for rate cuts. And as we sit here this morning, there's a school of thought that we might get 1 or 2 cuts at the very end of the calendar year. And that's very different than the mentality that investors began the year with. So there's been a measure of volatility in capital markets, as you all know, particularly with interest rates and fixed income returns, and we'll talk a little bit about that more momentarily. But nonetheless, thematically, got a big picture for Q1. It was a positive quarter, all else equal, and at the end of the day, for equities. Again, led by those large cap US names that you've read about, right? The AI related names, the NVIDIAs and the Metas and the Amazons to an extent, really were the predominant source of those returns, but they did drag the broader averages higher. And we'll show you those numbers momentarily. So that theme continued to play out in the first quarter. It softened a little bit, 2Q actually. And then the other kind of backdrop or theme, just for consideration from the committee's front, and this will dive a little bit into and provide a basis for some of our talk around the changes to the pension allocations. We continue to think the opportunities in fixed income are pretty robust. As you all know, obviously, interest rates, treasury rates, those base rates that fixed income markets price off of are much higher than they've been in quite some time. And historically, those interest rates have been good indicators and predictors for subsequent total return in fixed income. And we'll talk a little bit about that opportunity in a minute. So those are kind of big picture, under the hood, if you will, themes. Maybe jump, Tyler, 2 pages forward. Just in the interest of time. Here are capital market returns for Q1. And in the upper left-hand corner, you can maybe barely make it out, but the fixed income markets you see there were down a bit, about 0.8% in Q1. Again, a byproduct of those higher interest rates that we talked about, pressuring those total returns. The equity markets in the middle of the page, you can see the US large cap names that we mentioned being the leaders again, but you had good returns elsewhere in the world also. As you can see, small cap and the international markets were positive as well. In terms of the diversifying asset classes, things like real assets and commodities and the like, you see a little bit of a mixed bag there to the far right. The real estate market, we'll talk about this too, has been under a good deal of pressure, as you all know. Again, a byproduct largely of those higher interest rates, but some more broad weakness as well with the return to work kind of mentality. And then commodities were a measure higher. So we'll talk about that too. So that's the kind of the big picture backdrop in terms of capital market outcomes. Any questions from the committee? Is macroeconomic market themes or anything before we start to dive into the town's plans? Folks, okay? All right, as always, just stop us along the way here. So this quarter for us on the DB side is our investment policy review. You see the upper left-hand corner of our GovCal. So we're going to spend a minute here just reframing what we've got from a investment policy standpoint. There are some suggested edits that would align with the changes that we're proposing, again, assuming that you adopt them, that we want to talk you through. So I think right after Tyler, we should have the policy. Yeah, this is a good summary here. So your policy statements from our standpoint are in very good working order. You see there, we try to highlight and summarize for you good components, or if you will, for the blueprint for an effective policy statement. And your existing statements kind of fulfill all those factors, if you will. So we think the statements are in good working order by and large. And again, the only changes that we would have would relate to some of the target weights that we might adopt when we walk you through that exercise. So good shape for policy statement. If maybe we continue, Tyler, I think exactly. I think we could scroll maybe all the way to the very last page. There we go. So this is a busy page, admittedly. I'd ask the committee maybe just to kind of mentally warehouse it momentarily. The edits that we've made here, again, as I mentioned, would coincide with the reallocation of the pension assets should you approve them. So if you just keep that in mind as we kind of work through this other collateral, I think it'll come to make sense in short order here. So maybe if we continue, the other thing we mentioned, maybe one more page, Tyler. The other thing, just a quick 15-second reaffirmation for the committee. You folks do everything that you should be doing from a best practices standpoint. This is an annual reminder that we like to provide to committees just from a guidepost standpoint. You've got a committee, you've got a new chair and a vice chair, you're meeting regularly, you're taking minutes. We're providing the necessary updates and context, and I think you file all that collateral away through time, right? And you have a very nice file of an attentive committee and one that's effectively discharging its fiduciary obligations. So no concerns from our standpoint. Again, no actions here, just a reaffirmation for the notes, if you will, for the minutes that we think you're doing good work. Keep scrolling if you would, Tyler. Those are just our standard. All right, this page here is a good one. This is a busy page. We know there's a lot going on here. Let me try to summarize it for you. What we've done here is dusted off our latest capital market expectations for different segments of the markets. Equity markets, fixed income markets, domestic and international, real estate, right on down the list, all the asset classes that your plans currently utilize. And we test the return potential for that mix on a go-forward basis with the benefit of our latest assumptions. You see we've highlighted there in the upper left-hand corner the current mix that is deployed on behalf of the pension plans. And if you'll remember today, you see it's about 1/3 fixed income and 2/3 in equity and real asset. And then you see the component breakouts there we highlighted in the blue for you, just to show you what that mix may model to on a go-forward basis. And you see we provide you to a little bit further to the right there in the gray hash columns, some expectation around returns, a couple of different time frames. We'll use the 10-year number. It's a bit more conservative. That mix, we think, allocates somewhere to the order of an 8% per annum return, and you see the associated volatility. You all know, right, that we don't, it's obvious, but worth repeating, we don't get an 8% return every year. We know there's variability around that number. We get very good years, we get more challenging years, but with the benefit of time, the mix of assets you have currently with our assumptions should come in somewhere around 8% over a 10-year forecast period. The visual down on the chart on the bottom half of the page there, you see a bunch of dots. They coincide with the different mixes displayed in the upper left-hand corner, and they're basically representations of efficiency. You see how those mixes plot on the so-called, what a financial economist would call the efficient frontier, right? And really the practical takeaway for the committee is that your program is well diversified and kind of statistically in good working order, kind of under the framework and rules that we've built this optimization with. I talked earlier about fixed income having much elevated returns. And we've talked a lot with clients about the opportunity maybe to de-risk programs they measure because those higher yields we think provide real fixed income opportunities and can do so in a manner that doesn't really materially sacrifice the return potential of the program. So you see what we've done there. We scale in different combinations. It essentially increases to fixed income is what I'd have you focus on. And in particular, if you look at mix 2 there, you'll see a portfolio that is essentially has a take-up of 5% more fixed income in the pension plans than what we have today, and then a reproportion of the remaining assets accordingly. And you see there again, right under the hood, an optimal program, an efficient program, a well-diversified program, and a program that generates a return meaningfully close, pretty darn close, right? 7.7% if you work your way to the right versus 8, with material less volatility, 11.2% versus 12.4. So we think this is an opportune time for mature plans like the town plans are. We know what our goalposts are from an actuarial return perspective. We want to continue to build in a little measure of cushion over that actuarial return, but nonetheless, we think it's the right time in the return cycle and the interest rate cycle to dial back the risk a little bit. So the suggestion to the committee and what we talked to the Board of Finance about back over the winter was mix 2, which is slightly more conservatively allocated, but again, we're kind of fires on all cylinders from a return potential and an alignment with our kind of larger goals and objectives standpoint. So bear with that for just a second. If you go to the next page, Tyler, just quickly, if you wouldn't mind. So this is a better representation for the committee because it's kind of real dollars and where the program is allocated today. So you see what we've done there, the current mix, middle column, the proposed mix for consideration by the committee. You see the take up again on fixed income. We were rounding in the previous exercise, but you see here's the same basic takeaway. A bit more fixed income in the program. As mentioned, we actually are adding a little bit to domestic equity by virtue of that reallocation exercise, taking a little bit from international, and kind of diving a bit more into US just based on our valuation metrics and where we think the best opportunities are, leaving our diversifying assets, real asset and your Barings fund alone for the time being, or untouched, if I would. And then the only other thing under the hood here, if you're looking particularly carefully, we did talk to the Board of Finance, and the nature of investing overseas is evolving a little bit. And what at a point in time had been some pretty interesting opportunities in small cap international have started to dissipate. And we had suggested to the board, and they were comfortable with the idea of eliminating Templeton, as you see there, and reproportioning that capital alongside the new allocation. So that's a lot I know that I threw at you. Again, the summary takeaway is we've re-optimized the programs with the benefit of our latest expectations around capital markets and awareness, obviously, of what we're trying to achieve actuarially and elsewise with the portfolios. And this would be the actual steps that we would take upon your approval to reallocate the assets. Again, not dramatic changes, but changes on the margin, really to fully align your capital with your kind of very latest expectations and if, well, I guess our highest conviction ideas, if that makes sense. So let me pause there for a minute. I know that's a lot. Would love reaction from the committee if there's any, and Lisa or Todd from the Board of Finance stuff that we talked about in February. If you think if I missed something or something's not ringing true, please speak up as well.
Can I speak, Todd?
Oh, of course.
So first of all, thank you for that. I think that's exactly the direction the Board of Finance was interested in going, to do some de-risking, given that our actuarial assumption is 6.5. But for members of the public who might be watching, and there might be a few, can you just quickly explain how the actuarial assumption and your anticipated returns relate, and how we view
it's a great question, Lisa. You know, we didn't put it in this booklet. If folks are interested, we can get it for you. The other thing we do is, you know, when we're kind of running these simulations, the return that we display, that 7.7% return, you'll all remember this from high school statistics. It's our median outcome. Right, so we're running thousands of trials on your behalf, and we're creating a distribution of returns. And the 7.7% number is a median representation. What does that mean? As we all remember, right? Half the time we're going to get returns higher than that. Half the time we're going to get returns lower than that. So there is volatility around that expectation. And to Lisa, your question, what we like to do is we like to bake in enough increment, that 7.7 number being higher than the actuarial return, because when you look at a 25th percentile rank right? A lower rank than the median. It coordinates about, not precisely, but about with your actuarial representation. So we want to have a measure of cushion in our actual mix, knowing that there's that variability. And that's not insignificant, right? There's a 1 in 4 chance, essentially, that with this mix, that we get a return less than the actuarial number, right? There's some risk we're willing to take against that expectation, but that's kind of the mentality where we say, why are we building a program with an innately higher return potential than what the actuary is modeling? And we do that because of that variability and knowing, right, that returns are going to fluctuate year to year and period to period. So that's the way we think about it. We've got those numbers if folks would like to see them. We just, for the sake of expediency, we didn't put them in this deck. That makes sense or help?
Yes, excellent. Thank you.
But great question.
And the red line of that appendix that you showed briefly, you said that connects to the mix 2 on the.
Yeah, exactly, Todd, right? So that's coming full circle here, right? To the extent the subcommittee's comfortable and endorses these changes, what we did is we just proactively went back and recast your targets and your ranges to coordinate with that new mix if you adopt it. The balance of the policy statement, as we mentioned, is in great shape and doesn't need any further editing.
And just out of curiosity, the last update to that appendix was September 22. Do you remember what those changes were?
Yeah, I'm not sure, Todd, we had any. That might have just been the date of the latest endorsement.
Okay.
I can go back and look, but I don't recall there being any substantive changes last time we went through this exercise.
Yeah, I think I was on the committee at that time then, and I don't remember myself. I just wonder if we're like going back to where we were, or if we're.
Yeah, no, because this in this particular circumstance, I don't think we are, because the existing allocation in place for the pension plans has been there for quite some time. I think the first changes I think we're making along those lines. That makes sense to folks, kind of the way those things connect and what our motivations are.
Does to me. Is this something that we vote on as a subcommittee, or does this go to the board, the finance board?
I think, Lisa, right, the Board of Finance, as a technical matter, approved it subject to the affirmation of the subcommittee, right? I think is the way.
Yeah, so the charter requires us to consult with the subcommittee, members of the Board of Selectmen and the Board of Education before we take action. But the Board of Finance is the decision-making policy per charter. So because of scheduling and because we wanted to make sure we captured the interest rate high, we approved it, but made it subject to the approval of this board. So they will make the corrections if this board then approves it. So it was done a little backwards, but that was only because of scheduling. Typically, the retirement subcommittee recommends and then the Board of Finance approves. But this was just a scheduling to expedite the process. Otherwise, we'd have to hold yet another special meeting for the Board of Finance.
So then I guess I'll put it to a vote to this committee right now. If there's any discussion on this, if not, I'll take a motion to accept this change and to move it forward to amend the policy statement.
I'll make that motion.
Second.
Okay, thank you. All in favor?
Aye.
Aye as well. Any opposed? Okay, then we'll consider this one approved, and we'll make sure that that this gets updated appropriately. Thanks, everyone. Thanks, Chris.
Great, thanks, Todd. Thanks, everyone. We'll get you clean versions for the town record and whatnot. Maybe right there, Tyler's perfect. Thanks. So just I want to be sensitive to time, the rest of the agenda, and give Tyler his fair share the hour. Just quickly, you see performance. I'm going to use the town plan as the proxy for the other two plans because the numbers are basically right on top of one another. It was a positive Q1, as you see there, up 3% and change, about what the markets did. A good 1 year period ending in absolute returns, you see there 10%, so a nice double-digit number. The longer dated numbers kind of aligned with the general representation. These are net of manager fee numbers, as you all remember. A little bit of a relative challenge, as you see there, for the 1 year period ending in March. The benchmark did press a little bit higher. Without boring you with all the detail, you can kind of isolate that relative shortfall, which we don't think will be enduring or problematic longer term, to a couple of factors. One is the complexion of domestic equities. We have a bit more in small cap, given return expectations there, than their position as it exists in the benchmark. Small cap, as we've talked about, right, hasn't quite kept pace with large cap, but we think over time it certainly will return to a position where it offers incremental returns. So a little bit of the positioning in domestic equity has pressured that relative number down a little bit. And the other one that we've talked about previously, and we're front and center on in terms of due diligence and spending a lot of time on, is Barings and real estate. And it's interesting, we actually had with your colleague board in West Hartford last week, we had Barings in because they're an investor in the strategy that the town is in. And kind of interesting, the approach that Barings has taken, we would offer up to the committee, is much more conservative in terms of their appraisals and near-term expectations than their peer group. They are being much more conservative with where they're marking their properties. They're using higher capitalization rates than the independent third-party appraiser. They are repositioning the portfolio out of the office sector and into some other areas that they think offer better opportunities moving forward. And I think it's just the malaise generally that we've seen in real estate that you've certainly read about. And it's not isolated to just Barings. Really, all the managers are struggling to some degree. But on a relative basis, Barings, and we think that there's some rationale and good thinking behind their approach of being more conservative. They honestly are marking down the property appraisals that they're getting back from their third-party appraiser and taking even more conservative, a more conservative approach to those. So they are saying, listen, it's a difficult environment. We want to fully recognize an environment. We're going to mark down accordingly. Many of our peers are not as conservative as we are. Time being, they might look a little bit better on a relative basis, but we think that this approach sets us up going forward once we get a measure of stability in real estate markets and with some of the repositioning I mentioned. So those are really the two sources of that relative shortfall. Again, we don't think either are enduring or ultimately problematic, but it does warrant mentioning them. I wanted to give the committee that courtesy. But good outsized absolute returns for sure from the three programs over the last year or so, which is encouraging. We talked about the allocation makeups already, so we'll go through and execute those accordingly across the three programs. So that's the pension update. If you could scroll ahead quickly, Tyler. The only other item, and this is for safekeeping in front of our next meeting right here, if you would, Tyler. We do have MetWest, one of your fixed income managers, on watch. We're not compelled to take action this morning. We did want to get in front of the committee in advance of our next meeting, just a little bit of collateral around, depending on what our research team ultimately concludes on MetWest. If there's a need to recycle some capital, we've got some managers that we're monitoring, and we've put some of that information in your deck. Again, this is more stuff to warehouse if you're inclined to take a peek at it. When we meet again in the autumn timeframe, we'll reintroduce this information if it's necessary. That could be a pending change that we may want to talk to the committee about. Again, no action this morning, but just kind of a forewarning or a kind of an anticipatory approach to that segment of the portfolio. MetWest is still operating fine. doing reasonably well. No immediate run for the hills concern, but our research team is spending some time there. So we just wanted to, in advance of any ultimate decisions there, get some information out and just get into the atmosphere, if you will, get you thinking about that a little bit when we next convene, but no action. And then if you scroll ahead, Tyler, just to the OPEB so we can come full circle here. So the OPEB portfolio, upper left-hand corner of the page, running as you would expect, right? Essentially in line with the markets. We'll continue to be all indexed here in our approach. And you see decent returns both for Q1 and for the 1 year period ending, and obviously the longer dated numbers effectively align with the broad averages, of course, because of the index nature of the program. If you skip ahead, Tyler, 2 pages, just so the committee can see it. The one we just had there, I think, I'm sorry, perfect. There's, you see the representation of the different, the ETFs, you'll remember that we use here to express the strategy. Still well diversified, still, we think, allocated according to what we're trying to achieve actuarially. And I think good working order on the OPEB for the time being with no recommendations this morning. So I wanted to get you that information and update too. And with that, I'm way past my allotted half hour, so I'm going to stop there, and that's all I had for the committee, but happy to take questions before we segue over to Tyler's stuff.
Thanks, Chris. Anybody have any questions for Chris? If not, we'll move to Tyler.
Great. And Chris, you could take as much time as you want. I can do this in 5 minutes or 5 hours. So I will move efficiently through this today and get everyone out in the next 20 minutes or so. So this is our review of the defined contribution plans, obviously participant directed plans, and our focus this quarter is on fees, just so that the entire committee understands all aspects of those fees, because of course employees are paying those fees to participate in the retirement plan. And I think it's important. Again, this plan is an ERISA plan. It doesn't have to follow the guidelines that corporate plans do, but we find it helpful to follow as much as we can, what ERISA says, because litigation now, and I'm not saying that you'd be a target given your size for litigation or given that you're a municipality plan, but fees have been the easiest thing to quantify from a litigation standpoint, bigger, larger 401ks and 403bs. And it's just important that, this committee, deems the cost to be reasonable for the services that are necessary. And so what we do is put together a whole, chart around all aspects of the fees. I'll say record keeping fees, which is Mission Square. They do the record keeping services, and then investment costs. And then of course we look at transactional fees as well. So it's really all aspects of the fees. It's not just one number. And we have created an internal benchmark that we use that we think is a pretty a good barometer of how well the plan is doing compared to peer organizations, peer size plans, retirement plans. I'll talk briefly around trends. I'll get into your benchmarks, and then we'll touch on the funds. We don't have any recommendations for changes today, so no immediate voting items. The one trend line we're seeing, and right now your employees pay for record keeping services. Again, that's Mission Square to do the call center, the website, the statements, all the things that go into record keeping the retirement assets. They pay this service as a percentage of their assets, and we are seeing a movement more and more towards per head pricing, especially up market. And so what this is showing you is how plans pay for record keeping services, either asset based or per participant. The idea behind that is instead of everyone paying 0.16 for record keeping, they pay $60 for record keeping. And the concept is, if I had $1 million and Chris had $10,000, why should I be paying more for a service that we both received? And we're seeing just this year, we entered into a point where a 51% majority is now per head. Now, a lot of that is north of the $100 million mark. If we go to your size plan, you're still in the majority. At 80% of plans are still asset-based fees. So you're in line with the trends when we look at the set of the sort of size plan that you're in. But we wanted the committee to be aware that there is kind of this trend over time to potentially look at per head price. And again, we're very close to that majority, but I'd say you're still in line with that trend. And what we've done over the years as well is what's called fee leveling. This incorporates the investments that have revenue sharing that pay for record keeping services. And years ago, when we moved to and did the exercise around moving to Mission Square and lowering costs for participants, we went to a place where everyone, even though it is a percentage, is paying the same for record keeping. If you flash back to before 2019, index funds wouldn't pay any revenue sharing, and some of the active managed funds would bear a lot of the cost for record keeping. And we've moved to a place where everyone's contributing to record keeping services. No one's getting a free ride, and that's what's called fee leveling. And as you can see, 80% of plans now are what's considered fee level. I don't want to get into the weeds around net lowest cost. I did include some information around collective trust today. The savings I don't see as significant to move in the collective trust direction. So there are, essentially, let's call it two ways of getting access to investments in a defined contribution plan. One is through 40 Act mutual funds, which are the investments that you currently offer. Again, SEC registered. The other is through collective investment trusts, some which we've negotiated directly with the various mutual fund companies, some that various record keeping companies negotiate, and they're essentially pools of investments held at a bank or a trust vehicle that mirror or mimic the mutual fund, but just do so at a lower cost. Different registration requirements. One's regulated by the banks. Obviously, the other is regulated by the SEC. Mutual funds have ticker symbols. Collective investment trusts do not. But we're seeing in the 401k space, especially, more and more larger plans move in the collective trust direction to get access to those lower cost investment options. The benefit is, of course, lower fees, which is great. The considerations are, it can be somewhat confusing to participants, given that there's not a formal ticker symbol. It's not publicly available through a ticker symbol. You still get the performance reporting on, say, Mission Square website. There's also a fair amount of complexity around documentation and paperwork. I think and our role is just to show you where you can go from a fee standpoint. The fees are very minimal. The fee changes are very minimal. So I'd sort of propose a wait until we see more significant savings with trust vehicles, as opposed to moving forward with those trusts today. And I'll show you what those savings are in a moment. We use our own benchmark, 607 defined contribution plans. That's the New York Mets plan, that's Anheuser-Busch, that's Town of West Hartford, that's Glastonbury. We include all these the companies that we work with in this benchmark. We collect a significant amount of data. It incorporates 22 different record keepers, so that includes Mission Square, but also the Fidelities, the Vanguards, the TIAA-CREFs of the world. And we gather all this data. We started at the beginning of the year, collect it all. We put these data points in tranches so you can sort of accurately compare yourself against like size plans. Again, these are imaginary lines that we've created, but the 1 to 20, 20 to 50. Your plans are within the 1 to 20 mark, so you get an idea of what that benchmark is. And I'll show you some of the others, what the other pricing is for the, say, north of $1 billion plan. And so we think it's a good barometer for how your plan looks from a benchmarking standpoint. And then given that Chris is an expert in math. He said, well, half of your clients are going to be above the average, half of your clients are going to be below. So what we did is we actually went to a third party and got a third party benchmark just to compare. You know, if we're just giving you our information, why don't we give you a third party benchmark as well? So we have another benchmark that we can use to compare and make sure the plan is reasonable. So I forgot to warn you that this is a very numbers heavy quarter, but how you read this is, you have 15, almost 16 million as of the end of the year. What we're doing is taking a snapshot as of the end of the year of all of the assets in every single investment option. So the 2015 T. Rowe Price Fund had $195,000. The fee expense there is 0.35%. And then of course the fee in dollar amount. The right column is what's called, if there was any revenue sharing, often fund companies would share revenue with the record keeper or with brokers historically. We don't see that in any of the funds. We've kind of stripped out that for fee leveling purposes. We then go to the bottom. The average participant for investment expenses pays 0.34%. You see that translated into dollars. For record keeping the plan, the work that Mission Square does, they charge 0.1, call it 16%. You get that number in dollars there. And then so you add it all together, you know, roughly 0.50% total cost, you know, average weighted, could depend on where people invest. Out of that, you know, 16, call it, you know, 0.159 goes to Mission Square for record keeping. What we always like to, and I just noticed there's something in the chat. Oh, but they said drop off. Okay. The one thing I wanted to note is we always look at the forfeiture balance, and just a reminder what that is when people are unvested in the retirement account, those assets go into and they leave, the remaining assets go into a forfeiture balance. It is somewhat a significant number. The intent for that is if someone didn't earn their vesting, you know, the town still recoups that amount. Typically that's used to offset either expenses and or any employer related contributions. So again, this was as of March. I'm not sure if it's been reviewed recently, but you know, you have that to be able to use to offset some of the town's costs with respect to employer contributions. I'll pause there. Any questions so far? We did the same exercise for the 457 plan. Excuse me. I'm sorry. This is just showing you the collective trusts that are available. Again, as I mentioned, the savings is, you know, less than, call it, you know, $900. I think the confusion to add trusts right now outweigh the cost savings for plan participants. The risk, I say, is $900. I think it may create some confusion more so than benefit from that the sort of overall $900 savings across $16 million. So I think what I'll do is wait to recommend until you qualify for a few of the other trusts, any movement toward trust vehicles. But this, of course, this is there for the committee to see what's available. We do this at the Board of Ed plan here. You know, the difference is really just allocation. The record keeping cost is the same, but again, that the investment allocation is slightly higher, and then there's some forfeiture amount there. So a total of about $150,000 in the forfeiture amount. And then of course we show you the 401A, which is reflected here as well. When we look at benchmarks, so across the plans here, 0.50, we'll sort of hover around the 457 being at the bigger pool. We show you a benchmark of other $1 to $20 million plans that also have actively managed default funds. And that average is about 52 basis points. You're at 50. The total average is about 48. again, you're at 50, so right in line with that. You know, I'll say that the average record keeping cost for a plan to 1 to 20 million is you know, 0.25% or 25 basis points. You're at, call it 16 basis points, so well below the average for record keeping expenses, which again is you know, something that this committee can control more so, given you can negotiate those fees with Mr. Square through RFPs and other things. You can't necessarily control where people invest their assets, and if they just decide to select more actively managed investment options, that total cost can go up. But I'd say the record keeping cost is really competitive compared to peers. And then finally, this is our larger benchmark, all of the numbers. As I mentioned, you're at 50 basis points, so right around here. I mentioned we went to a third party to get their averages. This is a retirement plan advisory group, and we gathered that data. And for a $1 to $20 million plan, their total cost came out, our average cost came out at 1.05. So half of the third party average, right in line with our average. When you look at the overall record keeping fees, I mentioned you were at 16, so right in the sort of you know, 25th to 50th percentile here from a total cost. I'd say, you know, closer to an average for a plan 20 to 50 million, and of course that plan is at 15. So I think, you know, the summary, I know it's a lot of numbers, but the summary is really that the plan is reasonably priced for the services being offered. You know, the committee here is being good stewards of the staff of the town to make sure and ensure that the total costs are within line of benchmarks. You know, for the defined contribution services. We include transactional costs just to note that, you know, if anybody, let's say the fees were very low at Mission Square, but they were very high elsewhere, like in loans or other things, but we don't see that. You're right in line with the range from a transactional cost standpoint. Balance summary. So again, I was taking a snapshot at the end of the year because we like to say, okay, 2023 looked like this. As of the end of last quarter, you're up to about 17 million. So some pretty robust recovery, not only from the markets, but also I think contributions into the plan from you know, close to 15 to 17 million in the 457 plan. You know, bulk of the assets in indexed, the Fidelity Index Fund. You know, then that you have a lot of money in that stable value or plus fund as well. And then I think what's growing is that default, that target date fund, and the investments in the T. Rowe Price target date funds. Similar growth of the Board of Ed plan, closer to 2 million now from 1.25 beginning of the year, and then the 401A closer to 1.5 million from 1 million end of June last year. We include this slide every quarter. Again, this reflects the default fund, those target date funds, and you know, the T. Rowe Price target date funds have done extremely well, you know, across the board. So top decile performance. So you know, those funds are all on maintain. You know, longer term numbers for some of our managers are performing really well. No immediate concern with any of the investment options. We have no recommendations to, you know, terminate, or no funds on watch right now. You know, our annualized performance is here. So no recommendations for the committee today. I think in summary, the fees benchmark really well, and you know, fund performances and expectations with in line with our expectations. So I will pause there again, see if there's any questions around fees, any questions around the defined contribution marketplace, or the funds that are available. Perfect. Well, Mr. Chairman, that's all I had today.
Great, thanks, Tyler. Nice to see that with all the money that's going through, that the fees are right in line with where you would want them to be. People would like to know that. Okay, again, thanks, Chris and Tyler, for the presentations, Kelsey for putting everything together. Any other business for for the committee that anyone wants to bring up? If not, I will take a motion to adjourn.
So moved.
Second, anybody? Oh, okay, Heather, all in favor?
Aye.
We'll take that as unanimous. Thank you, everybody. Next meeting is scheduled for September 5th, I think is what we, no, September 3rd, I think it was what we agreed on. I'm looking at the minutes from last time. All right, thanks, everyone.
Thank you, Mr.
Thank
Chair.
Thanks,
you.
folks.
Enjoy the day.
Bye.